Welcome to The Property Code. I am Nick, and today we are tackling a question that floods search bars every night. Best ways to invest your money in 2025. The demand is focused and familiar. People type best ways to invest money, where to park cash while rates are high, index funds versus real estate, Roth or traditional, HSA or IRA, treasury bills versus CDs, and whether fractional or tokenized investments are finally safe. That chorus sets our mission. We will build a plan that respects higher for longer interest rates, new tech rails, and the timeless math of compounding. Meet the person who will carry us through the story. Her name is Mariah. She is a 38-year-old public librarian in Albuquerque who is excellent at organizing other people's information and terrible at organizing her own. In January, she wrote one line on a yellow slip. By this December, I will make my money work even on the days I am too tired to think. That sentence became her compass. Mariah began where most glossy lists do not, the safety shelf. She split her near-term cash into 3 buckets. The first pays the next few months of bills and lives in a high-yield savings account, federally insured and boring by design. The second is a short ladder of brokered certificates of deposit and treasury bills, each maturing a month apart, so she always has liquidity without guessing the future. The third is a tiny surprise reserve, a cushion that keeps her from raiding investments when the water heater quits at dawn. In a year when yields still stand higher than the early decade lows, her cash earned real interest without drama, and that alone felt like a race. With a floor beneath her feet, she moved to the automatic engine most people search as best long-term investment, the workplace plan. Her city offers a match on the first slice of her paycheck, so she treated that match like a mandatory bonus she would never leave on the table. She chose a broad target date index fund and turned on auto increase, nudging contributions up a single percentage point every quarter until they met her comfort line. For taxes, she used a simple rule. If current income is likely lower than future income, Roth contributions make sense. If current income is high and she expects a lower bracket later, traditional may be better. She did not chase perfection. She picked a lane, wrote it down, and moved on. Next came the taxable brokerage account, the place where many searches land after how to invest money with little time. Mariah created a 3-fund core, a total US stock index, a total international stock index, and a high-quality bond index. She set automatic contributions every payday, so discipline did not rely on willpower. She checked that expense ratios sat low enough to ignore. In 2025, many brokers offer direct indexing and automatic tax loss harvesting even for modest balances, so she opted in. That feature harvested paper losses during wobbly weeks, which offset future gains without changing the long-run plan. Once a quarter, she rebalanced gently, selling a bit of what had grown and buying a bit of what lagged. No drama, just maintenance. Bonds deserve their own conversation because the world changed since the near-zero years. Instead of hunting for exotic yield, Mariah favored short to intermediate treasuries and high-grade corporate bonds inside her bond index, plus a pinch of treasury inflation-protected securities as a hedge against stubborn prices. If she had been in a high tax bracket, she would have compared municipal bonds for their tax advantage, but as a mid-earner, the plain vanilla route fit best. The headline lesson stayed simple: bonds exist to be ballast, not thrill rides. Real estate came next because her searches kept returning to renting versus owning versus investing. She considered 3 paths and chose 2. The first was a public real estate investment trust held inside her retirement account, a frictionless way to collect property income without burst pipes. The second was a small, hands-off single-family home in a build-to-rent community on the edge of a growing Sunbelt city. The numbers penciled only because the builder funded a permanent rate buy-down and the management company ran a portfolio of nearly identical homes with durable finishes and smart leak sensors. The house did not promise huge cash flow on day one, but it was efficient to operate, likely to retain good tenants, and financed at a fixed rate she could live with. She passed on do-it-yourself flipping and on nightly rentals, both of which can work for operators with time and systems, but neither matched her appetite or schedule. A word on alternatives, because 2025 has made them unavoidable in search results. Private credit promises steady checks, tokenized real assets promise low minimums and faster settlement, venture funds promise a front row seat to the future. Mariah set a strict rule. If an investment could not explain fees, liquidity windows, and downside scenarios in plain language, she would not buy it. If it could, she kept any single alternative to a small single-digit slice of her total portfolio. She bought a tiny piece of a triple net medical clinic via a fractional platform that posted third-party leases and a simple waterfall. It behaved exactly as advertised, thin, boring, and on time. Crypto lived in the maybe drawer. She respected the technology and the new rails built on top of it, but she treated it like venture capital for civilians. A tiny satellite position, acceptable to lose without tears. A low single-digit slice of a dollar cost average position kept curiosity satisfied while risk stayed fenced. If prices fell, it would not threaten her plan. If they rose, it would not define her plan. Taxes and account placement quietly amplified everything. She kept high turnover assets and bond income inside tax-advantaged accounts when possible, and left broad index funds intaxable because their distributions are gentler. She used a health savings account as a stealth retirement vehicle, spending out of pocket on minor medical bills and letting the HSA grow. At year end, she looked for opportunities to harvest losses or gift appreciated shares to charity rather than donating cash. None of these tactics were flashy, all of them compounded. Insurance and debt were the moat. She checked that she carried sufficient liability coverage and an umbrella policy once her assets grew. She avoided carrying balances on high interest cards because no yield can outrun a double-digit interest rate dragging behind you. She treated her credit score like a weather vane rather than a trophy. A decent score lowers borrowing costs and opens better mortgage terms. Beyond that, it is just a number. Mariah also built a time horizon map, a tactic that helped her stop second-guessing every headline. Money she would need within 2 years lived in cash and near cash. Money earmarked for 3 to 7 years, blended stocks and bonds. Money for the far future lived mostly in equities because decades, not days, determine stock outcomes. That bucket view prevented one bad week from hijacking her whole plan. If stocks dipped, she checked the long bucket and left it alone. If rates moved, she looked at the cash bucket and adjusted a CD ladder, not her whole life. Technology helped without taking over. She kept a one-page plan in a cloud note, listing each account, its purpose, and its contribution amount. Her phone reminded her once a quarter to rebalance and once a year to raise contributions by a tiny amount. She muted most financial news alerts and kept 3 steady voices she trusted for education. She reminded herself that markets are there to serve you, not to instruct you. By autumn, the plan felt less like a spreadsheet and more like a rhythm. Dividends from her REIT landed in the retirement account. The build-to-rent home renewed a good tenant who liked the induction range and the quiet HVAC. The treasury ladder replenished itself with each maturity. The taxable account grew because deposits arrived every payday, whether headlines were cheerful or grim. When friends asked for the secret, she laughed. There was no secret, just the courage to pick good enough options and let time do what time does. If you want to copy Mariah's map, write one sentence tonight naming a monthly savings target and a reserve size. In the morning, capture your match at work and automate it. Open a simple brokerage and fund a 3-fund core. Choose cash vehicles that pay while staying liquid. Decide whether real estate belongs in your plan through a REIT, a managed single family, or not at all just yet. Fence off any alternatives, add a small slice, fix your debt at rates that let you sleep, build an insurance moat, then schedule a quarterly half-hour with your future self to check the plan, not the news. The best ways to invest your money in 2025 will not be the loudest. They will be the ones you can repeat when your week is heavy and your energy is low. They will be the ones that keep working when rates shuffle, when markets wobble, and when life interrupts. Pick the boring greatness on purpose. That is how ordinary paychecks become durable portfolios.